Welcome. Today we're diving into the world of tax assessment under Malaysia's Income Tax Act 1967. Tax assessment is the process where the Lembaga Hasil Dalam Negeri, or Inland Revenue Board, determines how much tax you owe. While Malaysia uses a self-assessment system, meaning you calculate and declare your own taxes, the IRB still has the authority to review and issue assessments if needed. This system aims to streamline tax collection and encourage taxpayers to be responsible and accurate. In this video, we'll explore the different types of assessments, how they work, and what you need to know to stay compliant. Let's start by understanding the basics before moving on to the specific types. Malaysia's self-assessment system puts the responsibility on taxpayers to declare their income and calculate their tax liability. This approach is designed to make the process more efficient and less reliant on direct government intervention. However, the IRB still monitors compliance and can step in if discrepancies are found. The self-assessment system encourages honesty and accuracy, but also means that taxpayers must be diligent in keeping records and understanding their obligation. Now let's look at the various types of assessments that can be issued under this system. Original assessment is the first type of assessment you'll encounter. It's based on the tax return you submit, reflecting the tax liability you've calculated. Under the self-assessment system, this assessment is issued automatically and becomes final unless you file an objection. It covers all the income and reliefs you've declared. This means that as long as your return is accurate and complete, the original assessment should match your expectation. However, if you notice any errors or omissions, you have the right to object within a specified period. Sometimes the IRB may discover that you've underpaid your taxes, perhaps due to an audit investigation or a simple error. In such cases, they can issue an additional assessment. This assessment is designed to recover any underdeclared or unreported income. Typically, the IRB can issue an additional assessment within 6 years from the end of the relevant assessment year, or 7 years in special circumstances. If you disagree with the additional assessment, you have the right to object and present your case. Reduced assessment is issued when there's a need to lower the tax previously charged. This can happen if you've overpaid your taxes, your objection is accepted, or errors are found in the original assessment. The IRB can only issue a reduced assessment within 6 years of the relevant assessment year, unless special circumstances apply. This process ensures that taxpayers are not unfairly overcharged and that any mistakes are corrected in a timely manner. If a taxpayer fails to submit a tax return, the IRB can issue a composite assessment. This type of assessment is based on the information available to the IRB, allowing them to estimate the taxpayer's liability. The goal is to encourage compliance and timely submission of returns. If you receive a composite assessment, you can object or submit your return to correct any inaccuracies. This mechanism ensures that tax collection continues even when returns are missing. Increased assessment is issued when there's an agreement between the taxpayer and the Director General during a review, or when a court decision results in a higher tax payable. This type of assessment ensures that any disputes or legal decisions that affect the amount of tax owed are properly reflected in the taxpayer's records. It's important to note that this assessment is only issued in specific circumstances, such as after a review or court ruling. Protective assessment is a precautionary measure taken by the IRB when there's uncertainty about the correct amount of tax payable. It's not a final assessment, but rather a way to safeguard the government's right to collect tax while waiting for more information. This is common in cases involving asset transfers, complex business transactions, or pending disputes. Once the correct details are available, the assessment can be adjusted accordingly. Advanced assessment, sometimes called a provisional or estimated assessment, is issued when a taxpayer hasn't submitted a tax return or failed to declare income on time. It's based on estimated income rather than actual figures. The main purpose is to prevent delays in tax collection and encourage timely filing. Once the taxpayer submits the actual return, the assessment can be adjusted to reflect the true liability. Advanced assessments are used in several specific situations. For example, when a person is about to leave Malaysia and their income is likely to cease, or when someone stops running a business. It can also apply when a person starts receiving employment income, ceases to have any income source, or is involved in certain business activities like transporting passengers or cargo by sea or air. Additionally, if the basis period for a business doesn't match the calendar year, an advanced assessment may be issued. If you disagree with an assessment, you have the right to file an objection. This must be done within 30 days from the date you receive the notice of assessment. The objection process allows you to present your case and provide supporting evidence. It's a crucial safeguard to ensure that taxpayers are treated fairly and that any errors or misunderstandings can be addressed promptly. If your objection is rejected, you can take your case further by appealing to the Special Commissioners of Income Tax. If necessary, you can escalate the appeal to higher courts, including the High Court, Court of Appeal, or even the Federal Court. This multi-level appeal process ensures that taxpayers have multiple opportunities to seek a fair outcome and that disputes are resolved according to the law. Time limits are strictly enforced for issuing assessments. For most cases, the IRB can issue additional or reduced assessments within 6 years of the relevant assessment year. However, in cases involving fraud or special circumstances, this period may be extended. These time limits are in place to provide certainty for taxpayers and ensure that tax matters are resolved within a reasonable timeframe. To recap, the original assessment is based on the taxpayer's own declaration. It's the starting point for all tax matters and is generally accepted unless there's a reason to object. Ensuring your return is accurate and complete is the best way to avoid future complications. Remember, this assessment becomes final unless you take action within the allowed period. Additional assessments are all about recovering underpaid tax. They are usually triggered by audits, investigations, or the discovery of errors. If you receive an additional assessment, review it carefully and consider whether you need to object. The process is designed to ensure that everyone pays the correct amount of tax, no more and no less. Reduced assessments correct errors or overpayments. If you've paid too much tax or your objection is accepted, the IRB can issue a reduced assessment to adjust your liability. This process ensures fairness and accuracy in the tax system, giving taxpayers confidence that mistakes will be rectified. Composite assessments are issued when returns are missing. They serve as a reminder to comply with tax obligations and allow the IRB to estimate your liability. If you receive one, it's important to act quickly, either by objecting or submitting your return to ensure your tax is calculated correctly. Increase assessments reflect changes after reviews or court decisions. They ensure that any agreements or legal outcomes are properly recorded in your tax records. This type of assessment is less common but important for maintaining the integrity of the tax system. Protective assessments are used when there's uncertainty, such as incomplete information or disputed tax treatment. They protect the government's right to collect tax while waiting for clarity. Once the correct details are available, the assessment can be updated to reflect the true liability. Advanced assessments are all about protecting government revenue when returns aren't filed on time. They're based on estimates and can be adjusted later. This type of assessment encourages timely compliance and ensures that tax collection isn't delayed by missing returns. Summary: understanding the different types of tax assessments in Malaysia is crucial for every taxpayer. From original to advanced assessments, each serves a specific purpose in ensuring fair and efficient tax collection. Remember, you have rights to object and appeal, and time limits are strictly enforced. By staying informed and proactive, you can navigate the tax system with confidence and avoid unnecessary complication. Thanks for watching and stay tuned for more insights on tax and finance.